Thank you so much, everybody, for coming. I just want to reiterate all of the thanks to everybody that Emanuele just gave. I will introduce my co-panelists after my remarks. But Emanuele decided that it would be a good idea for me to try to tackle the last 20 plus years of research in development and finance, at least from the micro perspective, in 15 minutes. So let's see how well I can do. But my goal is to set the table a bit. Where have we had a lot of research? Where could we have more? And maybe to pull on some threads, to at least show what threads we should pull on in motivating the other three panels later in the day. So I think that the group, when we're bringing finance people together and development people together, sometimes we have a bit of a conflicting goal or different perspectives on the same problem. So I think there are two views that we can have. The first is on the left, the relationship between the size of the financial sector and GDP per capita. So this is the oldest picture that I could find. It's making this point. This is data from 1963, in Goldsmith 1969. And regardless of how you plot this, what time period, how you measure financial inclusion or financial sector development, you get a strongly increasing picture. Now we can argue about how much of this is causal, how much of this is reverse causality or some sort of omitted variable bias, but I think all of us would agree that there are many theories and many reasons to believe that if we can expand the size of the financial market, incomes will follow and growth might follow as well. The perspective on the right is a very different one. So this is a figure from Ogunblik et al. From Zambian farmers, where individuals earn 90% of their income at the one maize harvest a year, and then they have to smooth their consumption across the year. And so this plot is showing the share of households in the sample reporting food shortages. So not having enough to eat, not having enough money to meet your basic consumption needs, this is directly welfare relevant. And you can see that over the year, there's a lot of variation. So during what they call the hungry season, almost 60% of households are saying they don't have enough saved to meet their basic consumption needs. And this is a failure of finance. This is a failure of consumption smoothing. That's also welfare relevant. So even if there's no link to productivity or incomes, this is still an important welfare relevant perspective for what financial market expansion is doing. So I'm going to frame my remarks with a couple of distinguishing features that are unique to LMICs or maybe are more extreme in LMICs. So these two figures show two of these features. The first is incomplete markets, and we're all here to think about financial market incompleteness. But it's not just financial markets that are incomplete, and understanding other sources of market incompleteness is really important to our job as people working in development. The second is the role of volatility. Households like these Zambian farmers, they have very lumpy earnings. They have predictable consumption smoothing needs, yet it's very hard. Also, they have weather shocks, households have climate shocks, and so the volatility environment makes completing these markets even more urgent. And I'll go over a few other examples as well in my remarks. Okay, so where does this incompleteness come from? So there are a couple of canonical reasons. One is transaction costs. And we have a vast literature, experimental literature, thinking about the transaction costs facing households and what happens when you relax each transaction cost one at a time. And there's meta studies showing that overall, when you do reduce these transaction costs, be it account opening, bringing the banks closer to you, defaulting income into savings accounts, creating features of these accounts that help overcome behavioral hurdles, on net, these things on the margin do move the needle in terms of overall savings. But I think what this shows is there are many, many different places costs enter, and there are many different reasons why people might not be getting what they need from the financial market. And so then this brings up the idea that we still haven't quite solved of tailoring. How do we make sure that the right products are getting to the right people and solving these transaction costs? The other reason underlying incomplete markets that's commonly been discussed for decades is information frictions. And we're just delighted to have two of the leading theorists of financial intermediation and information frictions in the participating today. And so a big role of what financial intermediaries are supposed to do is mitigate these information frictions. Yet in low and middle income countries, we know that this is especially hard. We know that strategic default has very high empirical relevance. So a very nice paper by Boone and Machiavelli, for example, shows in the context of the global coffee sector, 50% of default to the lenders is strategic. Carlin and Zinman have a very important foundational experimental design trying to decompose moral hazard and adverse selection, and also show that strategic default and is relevant repayment response to dynamic incentives. We have evidence showing that when you allow the disconnection threat, seizing collateral, repayment improves, et cetera, et cetera. So this is a very high problem, a big problem in LMICs that still is yet to be fully solved, although we have some hints of where we can go. Screening costs are also limiting. There's very limited borrow information in many contexts, and we have literature relaxing these frictions through credit registries entering. A lot of this work is from Latin America, through alternative data sources like cell phone records coming online, through peer information, work by Ben Roth, who's sitting in the room. And then monitoring costs, we also know, are super relevant. They're very high monitoring costs per dollar lent if there's a fixed component of those costs, but there's been less work kind of showing how we can tackle that feature. Microfinance, for example, is investing very much in monitoring in order to generate the low default rates. Then, of course, another distinguishing feature of LMICs are weak creditor protections and the limited role of the state, the insufficiency of bankruptcy procedures, et cetera. And so I think all of this raises two issues. One is on the theory side, but the other is the promise of digitization that's going to link to our fintech panel. How much can digital public infrastructure, new data trails, open finance information sharing, the ability to perhaps to customize contracts, how much can this play a role in really addressing market incompleteness? And so we're really excited about that panel this afternoon. Okay. So maybe because of all of this, a stylized fact is that banks and formal loans don't really reach the vast majority of individuals and households in low-income countries. This is from the 2025 issue of the Global Findex put out by the World Bank. And you see, especially in South Asia and Sub-Saharan Africa, quite low rates of individuals who have any access to formal credit. However, 70% of households in those contexts are borrowing from somebody, but formal credit is not what's really filling that gap. And we've seen in the literature, there's a very nice, robust set of studies documenting positive impacts of branch expansions. So the Burgess and Panda thought about this in the context of India and documented decreases in poverty headcounts. Kim Kramer, who's been working more recently in this space, uses an RD methodology to show that this also leads to improvements in health and savings, credit to health enterprises. And other work by Barboni et al. Shows that an entry of a microfinance bank that also provides multiple different types of services has an 8% reduction in poverty. So this is good news for when we can figure out how to expand the banking infrastructure. Okay. So I think one thing that is important and maybe sometimes underappreciated is the fact that this is not only about incompleteness in the financial market. Incompleteness in other markets is also relevant. Land markets don't work well. Property rights don't work well. Labor markets are often frictional. And then we have wealth constraints for many potential entrepreneurs and households. And we know from the theory, from the development side, that there's a problem when multiple markets are incomplete at the same time. For example, a failure of separation. And this can lead to incomplete decisions in one domain spilling over into another domain. It can lead to factor misallocation. And then when we're in the world of the second best, partial market completion, as sometimes we're seeing in a lot of these studies, may actually have ambiguous effects. And so here's another place where there's a key role for theory to play in studying financial development. You know, the impacts of financial development need not be monotonic, all going in the same direction. Moreover, given that different countries are at different points in their financial development, there's no guarantee of generalizability across settings. And so we need more theory to help guide us when we see a result in Brazil. Where else is that is that where can we extrapolate that? Or when we're trying to think about Zambia, what at a lower stage of development, how should we think about financial market expansion? Okay. So just I'll go through this briefly. Networks and informality are often arise in response perhaps to the formal market not working. So in the same picture from the global findex, we see especially in South Asia and Sub-Saharan Africa, very high reliance on family and friends for loans when the financial market isn't there. We see this also with startups. This is evidence from Manila and Tomaso that's hot off the presses. Personal savings and resources from family and friends, especially for smaller firms, is incredibly important early on for those firms. And then in work by Khwaja and Mian, we see the importance of firms being connected through director networks to the actual banking system. And so this is something that we see across many domains in development and finance. And I think now that new data is potentially coming online, we should think through more carefully the implications for inequality and misallocation, how to give firms better networks, and then does development crowd out some of the relational contracting that's going on in the background? So when the market is completed, it's not that there was nothing there in the first place. There were all of these informal contracts in the background. Okay, so another key feature of LMICs that is relevant for our study of the income generation benefits of financial expansion is the role of self-employment. So this is a figure from Gapminder with GDP per capita on the x-axis and the self-employment share on the y-axis. And you can see a very, very steep gradient. Poorer countries have far more self-employment. And we have a recent body of evidence that's really showing that a lot of this pattern isn't by choice or because people have great productivity ideas. It's because the labor markets aren't working. And so a very nice paper by Donovan et al. Shows that churn in and out of self-employment and work is very common. And so in some sense, self-employment has more in common with, a response to unemployment than actually meaningful choice of being an entrepreneur. And so this has several potential implications, these patterns. The first one, it might be, well, financing businesses is more important because so many more people are in self-employment. And I think that was the view of the first wave of the microfinance literature. I think the second issue that arises is, well, if the same people who are entrepreneurs are also solving their household consumption smoothing problem, now we might have contaminating effects from those two issues. We might have multiple borrower motives, and we might have a different set of effects coming from completing the financial markets or from offering credit. And then finally, this might actually induce weak selection into entrepreneurship, making it even harder to screen out the potentially productive businesses and help them grow. And given that so many individuals are going to have low wealth. Okay, so I'll go through quickly. The literature, I think, from the development side is focused a lot on microcredit. And I think this is because it's one of the only private sector scalable solutions that has been able to take off among low-income populations. So against the backdrop of 10% of households having access to formal credit, microfinance has been quite a success. And so we've had a richness of empirical studies. There were 7 RCTs from 2005 to 2010, and there have been even more. And I think the results were quite disappointing. So there were modest improvements, increases in investment, but nulls on profits and nothing on consumption. But I think this fact that so many people are in entrepreneurship, not because they want to be entrepreneurs, but because they have poor job prospects, is quite relevant for interpreting. So for example, in the India study that I eventually participated in, only about half of the microfinance borrowers have any business at all. And so many are borrowing for consumption and not business growth. And so if we just split the impact 6 years later on profits between people who had selected into entrepreneurship when credit constraints were really tight versus people who didn't have a business ex ante, so maybe these people who are churning, like in the Donovan et al. Paper, we see very large profit effects for that subsample. Okay, so this has now suggested a couple of different refinements, and I think there's been a lot of progress made on the development side toward this. So first, this suggests that there are benefits from improved screening. There are a lot of people who aren't in entrepreneurship with the goal of growing, but how do you find them? And so So Dean has a very nice paper trying to say, well, let's give even bigger loans to businesses. And he shows that self-screening doesn't work very well. But if you screen in the people with high potential returns, then a loan that's 4 times as big as the typical loan size generates very large profit returns. Asset-based financing has also shown some promise, where graduating from a micro loan to a $2,000 asset purchase with a higher pay contract increases the assets in the firm and also increases business profits. And there's scope for digitization and increased data to do even more to help screening and targeting, but I think we're not quite there yet. Another question is, how do we move beyond rigid debt? So microfinance repayment forces you to start repaying right away. And you have to pay a fixed rigid schedule. And so we have a bunch of papers, some work and some don't, but we're starting to get a sense that giving flexibility in a way that's more natural for the cash flows of the business might lead to higher returns being unlocked. And so I think a big question that we haven't yet reached, and I think is a goal for the literature, is how do we move toward equity-like features? And there's some really exciting nascent work on this, thinking about performance contingent repayment, revenue-based financing, moving toward microequity, and also trying to think about customization. But again, this is all very new. Okay, so I wanna just stop with after this particular slide. So this kind of came from talking at dinner with Chris and Tommaso and Emanuele. We can think about the research looking at firms across the firm size distribution, and then financial products going from rigid debt to residual claim and equity. And a lot of our work is for very small firms with rigid debt. And we do have some work thinking about bigger loans, so priority sector policies, Dean's paper, some of the branching expansion work. We have some work thinking about equity, but definitely not enough. So David McKenzie has a very nice paper giving grants to young entrepreneurs in Nigeria. But we need to do a lot more to fill in this space. We also need to match the reality of the research with where the financial constraints actually are. And so I'm excited about our panel later about DFIs and equity, to think about where should the priorities for the market expansion should be. Do we need larger loans to mid-sized firms? What about deeper equity markets, and what's the role of local versus foreign capital? Okay, so I will leave it there. And I'm thrilled to, just a second, introduce my co-panelists. So first we'll have Chris Woodruff, and he's interning for Austin Quanta. Austin is very excited he couldn't come, but he was stymied by the storms and runway construction at Logan. And Chris is a professor of development economics at Oxford, and notably he's of private enterprise and development in LICs with that hat. Next, we'll have Amit Seru, who's a Stephen and Roberta Denning Professor of Finance at Stanford GSB. And he's been working in, I think, one of the most dynamic spaces in finance, not in developing countries, thinking about shadow banks and regulation and financial intermediation. And he's also thinking about some of these issues in the developing country context. He also has a hat as a former editor of the JF, so we're thrilled to have Amit. And then finally, Tarun Ramadorai from Imperial College London, who's been thinking, again, who represents one of the other super dynamic places of empirical finance research, which is household finance, and how to think about bringing those ideas into middle-class households in developing countries, and also has a hat as a journal editor at the RFS. So we're thrilled to have all three of them, and I'll hand it to Chris.
I'm going to go up there as well.
Yeah.
Okay. Thanks, thanks. Thanks, everyone, for coming. I'm stepping in for Azam Khwaja, so sorry to disappoint in that regard. Also, since I found out about this on the way to dinner last night, and some of my ideas have already been captured by other speakers already as we talk to them at dinner. I'll sort of have less to say in a sense, but I want to give kind of a higher level kind of. I'm going to make 4 points and just sort of at some more sort of conceptual level rather than I mean Emily's talk is a real tour de force in terms of really going through the literature and understanding in detail we've learned, and I kind of want to step back from that and reflect on what I think we've learned and what I think where I think we would benefit from research going forward. So I'll start by sort of with an anecdote from Pedal started about 15 years ago, and at the launch conference, I think two things stick in my mind from that. First of all, Stefan Durkin, who was at the time chief economist at DFID, showed a slide where countries were sized by how many publications using data from that country were in top 5 economics journals. And as you can imagine, at that point, and this was 2011, the US was enormous, Europe was pretty big, and the rest of the world was almost non-existent. And I think we've come a long way from that. We have much more research now on using data from lower income countries, and that's a very positive thing. That reflects methodologies. It reflects the work of a lot of people in this room and a lot of people who aren't in this room, and so forth. And so I want to say I think we've come a long way. The second thing I remember from that conference is a conversation I had with John Holtwanger, who was there, who said, "Are you all going to just fund RCTs?" And I said, "No, we really want to fund things that are not just RCTs. We want to fund other things." Well, in fact, what we've ended up funding is a lot of RCTs, mostly RCTs. And I think that's, I won't say it's a mistake, but it's a limit in a sense. And I think we need to try to think about how we move beyond that. Now, I think we're moving into a better space where we think about having access to administrative data, and sometimes administrative data combined with RCTs, which is quite useful because it allows us to kind of think about how these things scale. So with that in mind, the first point I want to make is, we like to look where the light is. So development economics has in some senses for very good reasons focused very much on causality and very much on RCTs and so forth. That's gotten us a long way on certain issues, and in particular on things that are we're able to learn with relatively short run impacts. There's an increasing number of long run follow-ups from RCTs, but it's more problematic in a sense. It's more difficult to kind of think about the longer term impacts usually. But if I just take one area in particular that we'll hear about some about later today when Paul Niehaus talks about Give Directly, but the work on capital drops, the work on conditional cash transfers, the impact of giving people assets and letting them make decisions that are productive. I think the research in that area has been influential in developing some policies, the targeting ultra poor programs, Give Directly, other things that have been quite impactful in terms of that's a place where I think the research has fed in to larger scale programs and to places where we're more we're making more progress. Second, we go in search of power. We often, when we design experiments, we design them with heavy use of subsidies and things trying to get sort of drive take up and things like that. That's somewhat artificial. So that may be part of the reason that it's hard, in a sense, to scale these into now I want to try and find my slide, which is down here. And then so with that, so we go and is that going to give me full screen? No, yeah. Okay, so the third thing is that I think so this is a slide, first of all, from a paper that Aditi Mahon and I wrote for SCDO, assessing kind of some of their work that they've done on small medium enterprises. The format steals from Dean Carlin's work with USAID, thinking about buys, and so the vertical distance here is how much evidence we have on a given program, and the right left is what's the return, and this is a return relative to cash grants. And so the thing that I want to point out on this is that if we look at the results we get, and this is a point that Emily made, microcredit and SME loans even look disappointing relative to cash grants. But the thing is, when you give somebody a cash grant, you don't get anything back. And when you give them a loan, you get something back. And so our sense when we looked at these the best calculation we can make is that in the studies that these numbers are based on, roughly 70% of the capital comes back and can be lent back out. And actually, when you take that into account and you say, what's the return on the capital? Well, it turns out to be a whole lot more, and it actually outperforms grants. And so those are, it's often, if I think back about the Hyderabad paper, I was struck by how big the returns to the loans were, even though the standard errors were even bigger. So a lot of those studies, the question of whether we're learning we're taking the right lessons from them in a sense of this, and so that's one point to make from this. The second point to make from this is over on the right or someplace, without enough evidence at this point, we have flexible microcredit, which again Emily discussed, where we see much more much higher returns. The microequity work, the sort of flexible payments, and so forth. We're not really seeing that scale. We're not seeing practitioners take that up. So, in a sense, I think the research, the payoff from novelty is too high, and in development practice, it's too low. If I think of the conversations I've had with MFIs where I'll say, look, there's evidence that this flexibility is valuable. Why aren't you doing it? They sort of say, look, we know what they're risk averse in a sense. And Ben and Natalia have a nice paper on this inside some of these MFIs, the incentives that loan officers have. But it's also at the MFI level itself that they don't capture the upside. If somebody gets a 30% return instead of a 10% return, they don't get the additional upside. They do take the downside, and so they tend to be risk averse. And so my take on this is that we need to be working with the funders of some of these things, the development finance institutions, the FCDOs, and so forth, to get them to encourage people the lenders to try to push some of these sort of more flexible. These have high social returns. They don't necessarily have high individual returns. We need to figure out how to get that. And so with that, I'll stop. Thank you.
Sorry, number.
Yeah. I don't know how to get rid of this thing.
On the right. Yeah.
Oh, here. Great. Perfect. Thank you.
One on the bottom.
Is there an X on this one too?
Okay. Thanks to Emmanuelle, Emily, and Chris for inviting me. It's always a pleasure to come back and talk about this with former colleagues. My foray into finance and development was two papers that both were written by colleagues here. One was Financial Development and Growth by Raghu Rajan and Luigi Zingales. And I read another paper by Sendil Mulanathan and Marian Bertrand about ferreting out tunneling, and I just didn't quite understand how the two fit together, because one was saying finance is amazing, and the other was saying, well, it's all captured. So that's going to be a recurring theme about what I'm going to sort of say, and maybe we should not just restrict it to development. Developing economies might also need a reminder. This is getting recorded. All right. So the two sort of key things that I will say again and again is that if you look at the lessons that we have learned from 40 years of work, it's that institutions, whether it's laws, courts, supervision, matter for finance, not just what finance does in the economy, but the contract menu, if you will, that is offered. So yes, finance matters, but it's an equilibrium outcome of many of the things in the background. So same policy or tech intervention, because tech is going to be a big theme, that might yield to outcomes such as a lot of secured and relationship-oriented credit leading to growth, might show up as completely different form of financing in other contexts. So that's kind of important to keep at the back of your mind. So the key takeaway after I'm done, hopefully you'll take from my talk, is going to be that it's not whether institutions matter for financing, but it's how do we move from an equilibrium where the constellation of institutions seem to matter, but we are still stuck in a weak governance equilibrium. How do we move to a good equilibrium with strong governance? Because one worry always is that incumbents, yesterday's winners, control financing and the rules. And that's no different when it comes to data. So we should keep that at the back of our mind. Okay, so what have we learned from the literature of 40 years? I think Emily did a fantastic job, so I don't need to say anything much about papers. Finance is an equilibrium outcome. Bunch of papers talking about weak governance related to recovery frictions, slow quotes, and so on. And what does that do? It leads to certain sorts of financing only being prevalent. We talked a little bit about rigid debt financing, so secured relationship lending, thin public markets. So what that will do is there will be systematic exclusion, whether it's small, medium enterprises, whether it's startups, whether it's households. That's something that's just going to be inherent in that system. And then we have learned on the other extreme that strong enforcement and strong governance kind of matters. It leads to arm's length financing. You have deep public equity and debt markets. You have longer maturity contracts. You have unsecured credit and inclusion, which includes startups, and therefore innovation becomes a part and parcel of the system. So, you know, there's been a bunch of work which has sort of shown this in different contexts, like I said. So just to give you some sense of how this work has tried to show that there are interlinkages between governance, institutions, and financing and what it does to development, like you've seen many of these. So there are lots of papers about insolvency and courts and how timely resolution and recovery makes unsecured credit feasible. Bunch of work on collateral and registries and how that enables more secured lending, and not only real estate, but beyond it. Real estate is a big component of, obviously, in developing economies. But how do you go beyond that? A bunch of stuff on market design, disclosure. So all of these things like listing rules, auditing, trading fictions lead to deep arm's length markets, which you need if you want to spur risk capital like venture capital and private equity. And then having a system of prudential supervision so that not just in monitoring banks, but also in the bankruptcy context, so that there is good entry and exit. And as well as that, we have stability and trust in the banking system. You're seeing a lot of new work, which is all about tech now. So a bunch of stuff related to information infrastructure, so credit registries, open banking. I'll leave it for the panelists later, talking about how that influences things like reducing potential adverse selection, increasing inclusion, and so on. And then even more work on digital ID and KYC and so on, and how that sort of reduces frictions and increases the scope of where financing can operate. But these papers don't really talk about how you change the equilibrium or which of these constellation of institutions matter more versus others. So should it be a big bang? Should it be slow? And I think that's been at the back of why a lot of the finance work, I feel, has not taken the next leap, but it's a hard problem. So I don't know if I have answers. But maybe tech is the answer. I just came from Silicon Valley, so everything is fixed by tech, fintech, crypto, AI. But all of these things are going to invariably collide with the same state governance. So just to give you some idea of what I mean by this, so that we don't get too euphoric. It's good to be euphoric, but not too euphoric. Let's dig into why tech and its potential might face issues of state capacity when it comes to governance, and therefore its scaling. So think about a simple 2x2. So you have state capacity, strong and weak governance, and then you have fintech coming in, or AI, or whatever, crypto, whatever you might feel like. I already talked about the weak governance and the strong governance and what that means for financing and its connection to growth. If you have amazing fintech coming in strong governance, you can scale because you can do a bunch of other stuff. But if you encounter weak governance and state capacity, you're going to have fragile and non-scalable access. So I'm thinking about when you sort of think of state, like think about resolving fraud problems, recourse problems, gaps in regulation. Where is that going to be taken care of? Tech and crypto, as much as we like, don't necessarily solve all of these things. So if you're sort of wanting to think about this a little bit more and why this doesn't solve all the problems, let me give you a concrete example. So this is Mercado Libre. You can think of this as Alibaba of Latin America. So it has an e-commerce side and it has a lending side. And through lending, it's hoping to increase financial inclusion to small and medium enterprises. So this was a study that I did with Bank for International Settlements long ago, where in Latin America, much like most developing economies, you have credit bureaus. So at the bottom, but it's pretty coarse what these credit bureaus can tell you for all the reasons we've already discussed. So let's say you have 3 buckets and you can figure out low risk, medium risk, high risk. Incomes, Mercado Libre, it uses its e-commerce side with machine learning, AI, and constructs a score based on, hey, what are your claims, what's your reputation score on the e-commerce site, and so on, and who do you trade with, and so on, and construct a score. A, B, C, D, E. E is high risk, A is low risk. And once you overlay this, you can actually see that this has more information than just what the external credit bureau might give you. So within each bucket, you have A, B, C, D, E. Remember, E is high risk and A is low risk. And does it matter? Does it have information? Yes, that's what a lot of papers now are showing. And this is the same thing. So it's loss percent on y-axis. And within each credit bureau buckets, you can see that E defaults more than A. So there is more information there. But what's also interesting to see is the size of the bubble. That's how much lending they're doing. So of course, they are profit maximizing. They give more to low risk and less to high risk. How did they decide high risk? Well, you enter back into state governance. It's the same things, like state has decided there's recovery, there is no recovery, there are recovery frictions, and all these high risk people are going to be still excluded. So the scale is going to be limited. And this is not taking into account that the data that they're using, of course, could also be potentially influenced by the same incumbents, which led to the weak equilibrium sustaining in the first place. So digital and tech doesn't solve the fundamental problem, I think. I want to conclude with 2 things that Emily and Emmanuel asked me. So in terms of current work, what's going on? Lots of work, exciting work going on. So looking very seriously in a well-identified way, collateral registry openings and what does that do to unsecured credit, looking at court reforms, bankruptcy reforms, and seeing what that does to credit. looking at rate caps and guarantee tweaks to see if the composition and structure of credit changes and exclusion sort of goes down and inclusion goes up. Looking at taxed invoicing and how that affects trade credit and through that small and medium enterprise survival. Open banking, which again I will skip, but the idea there being that you can use a lot of data to expand the frontier. And then digital ID and KYC, trying to sort of go beyond just informal credit and microcredit. So lots of stuff there. But notice that these are again a constellation of institutions, and you don't know how you want to sort of move from the weak equilibrium to a stronger equilibrium. Which ones do I need to do first? How much does one matter? We are kind of seeing that reverse experiment right now in the country that we all love. So we'll probably find the answer. Maybe three bigger questions back to the theme that I was saying, which kind of push us in the direction that I'm hoping we would go. It's a tough problem, like I said. My job is not to give answers, but pose questions. So, for example, do most inclusion gains come from lowering verification and enforcement costs or from cheaper subsidized interest rates, some of which come from tech? I don't know the answer to that, but it's worth sort of thinking about. Does fintech or tech disintermediate the state, or are there complementarities? So in that sense, without state capacity, you can't go beyond a particular point. And without functioning insolvency process and state, does digital credit just reallocate within elites and incumbents more than it expands the frontier for included? So yes, we are very euphoric looking at a part of the ecosystem, but really the payment rails and the digital rails and the data rails are all controlled by the same incumbents who were yesterday's winners. So we are back to the same bad equilibrium. So I'll leave it at that.
Okay, great. All right. So I hide this. Hide this. Okay. Good. Okay. All right. Well, thanks very much for inviting me to do this. I'm going to focus on household finance, which is the field that I've been working in for some time now, and see if I can sort of tell us, or at least talk a little bit about what has happened and what I think should be happening in this area. First thing I want to do is just sort of bring to your attention something that you've probably all seen many times before about daily income per capita. The left-hand plot shows what the pyramid of income per capita in constant PPP adjusted 2011 US dollars is. On the left-hand side is 1975, and on the right-hand side is 2015. And so obviously that pyramid has changed most recently because of the fact that Asia has grown very, very rapidly. So propelling a lot of households beyond the vertical line, which is the poverty line that the UN defines. This is just reproduced from a book that John Campbell and I have written that's coming out next month on personal finance, which is for public consumption, I guess. Now, what has this done? It's put greater demands on the personal finance system because the middle classes have grown. There's got to be a little bit of a focus beyond financial inclusion to what happens once you've been included. People are living longer lives. The traditional family structures are dissipating. They have smaller families. They rely on financial contracts rather than informal associations or social contracts with other people. And of course, there's lots of urbanization. This is something that all of you know. But the thing that I want us to focus on a little bit is that this new middle class status can be very precarious for many of these people, because as soon as they enter the formal financial market, they don't really know what they want. They know that they need something, but they're not quite sure what they want. They're very unsophisticated, which has been a theme that the household finance literature has been focusing on for some time now. But they're also in an environment that is populated by predatory suppliers. And as Amit has just discussed, there's imperfect regulation. So obviously, if you put all of this stuff together, it's a pretty toxic cocktail, and it can make for some pretty poor outcomes. So what do we know about the household balance sheet? I can sort of list a few things, but I also want to show you some pictures. But very quickly, savings are small and irregular, but growing fast. There are pecuniary and non-pecuniary transactions costs that prevent formalization, or at least from the household side, prevent people from getting into formal financial institutions. Expanding access is difficult. Financial market participation is actually quite low, despite the characterization that we know from finance that everyone, even however risk averse they may be, should have at least a little bit of stock allocation. The asset allocation to financial assets is very low, conditional on participation, but it's also consistent with a tangibility preference. So many people have lots of real estate and lots of gold in their balance sheets. I'll show you some pictures on this. There's enormous amounts of unsecured informal debt. There's lots of people in this room that have done work on this. And then a theme that I think is quite important is that mortgage borrowing is very low. And the usual life cycle patterns are absent. In fact, if you look at emerging and developing economies, and if you look at the household surveys in these economies, the official ones, you'll find that the old tend to borrow more than the young, which is exactly the opposite of the life cycle patterns that you should be seeing. So here's a little bit of work that kind of updates a survey article that Vimal Balasubramaniam, Christian Badrenza, and I wrote for the annual review of financial economics. And this is from the most recent household surveys. On the left-hand side, this is the asset side of the balance sheet for those who have assets that we can sort of look at in this sense. It's wealth weighted across all households in the survey. And so you can see that in the US, the UK, and Germany on the left-hand side, and even in China, things look quite different from when you move to India, Thailand, and South Africa. Much more real estate as you move to the right. And there's things like gold, lots of durables on the balance sheet. And if you look at the liability side, the picture is even more stark, which is there's tons of unsecured debt on the balance sheet, very little mortgage debt, and even less. And there's some secured debt. If you put, if you sort of look in here in South Africa, some of this is, sort of interesting. And then Brazil, if you were to put over there, would have much more in terms of motorcycles and things like that. Okay, so these are sort of quite different looking patterns. And so I guess the big question that I have, and the thing that I would like to sort of push people to do more on, is to sort of try and understand why those differences are there, why those life cycle patterns don't exist in the way that they should, what frictions are preventing emerging financial markets. And I think we should focus on the large needs to begin with: mortgage financing of real estate, educations, pensions, and insurance. We've heard about technology and we've heard about why it might hurt. But I think if we had a focus on household finance, I think one of the things that we'd like to understand is what can help to lower the fixed costs of participation in many of these kinds of financial products like mortgages. What can reduce search costs? There's been some reforms, but they need to be more perhaps. Which ones should they be? How do we develop customized financial products? How should we conduct consumer financial regulation and enforcement in developing financial markets? I mean, what should be the focus? What should we really try to stamp out? And what should we focus on? And then, obviously trust is a big issue. Corruption and perceptions of corruption are particularly big issues in environments with weak state capacity. And there's a sort of feeling that some people have that financial education is a solution. It's helpful, but I think I'd be amongst people who think that it's not the entire answer. And so we need to understand how to complement financial education or indeed increasing sophistication with other moves, regulatory moves. Okay, so as with my editor hat on, one of the things that I've tried to do is to sort of push this agenda forward a little bit, and not just in household finance, but in finance and development more generally. We've co-sponsored with WeFi Dev an RFS dual submission initiative on finance and development. We've run one conference already at the LSE last year. The call for papers is open right now until November 18th, and the next one's going to be in Chicago at Northwestern at Kellogg on April 18th, I believe, is the date that we've set. And then we'll do one more after that. We had 327 submissions for the last one, which is a good start. They came overwhelmingly from pre-tenure faculty, which is great. So it sort of shows you that there's a lot of enthusiasm from younger people in the profession. They came from a range of different continents, which is nice as well. I'll tell you a little bit more about the primary field of the paper, and about 70% of them selected RFS, the RFS dual submission option, which gives you a sort of no fault option of going for a submission, and if you get rejected, it doesn't count. You can go again, which is quite a valuable option. So here's a little word cloud. I should thank my colleagues at WeFi Dev for helping me with this, of what the submissions contained. And you can see that there's sort of a big emphasis on corporate finance, banking, financial intermediation, and credit. A little less than I would like thus far on asset markets, on product design or market design, some of the themes that we touched on already. But we've made a good start, and I think there's more to do. So thanks for giving me the chance to talk.
Great, but before opening the floor to audience questions, I wanted to just pose one question to each of you. So first, Chris, we're sitting here in Chicago talking about LMICs, and this is something you've thought about a lot in the context of Petal. What are your insights after doing this so long about matchmaking, both researchers in LMICs finding firms and opportunities to study?
Yeah, so I think, this is a place where we've had more success in some places than others. And, but it's clearly quite important that we figure out how to engage researchers in country, resident in countries much more than we do now. And I mean, it's important for a lot of reasons. One is local context, understanding the issues, access to the ability to access data. As I said in my remarks, I think the movement towards administrative data, the amount of data we have now, whether it's banking data, credit bureau data, loan data at the detailed loan level, or VAT, CIT kind of data on the firm side, accessing those data and getting the regulators and agencies that have access to them comfortable with being able to use them is really important. And the third is that we like to kind of think that we're going to write a paper, that a policymaker is going to read the paper and they'll change policy on the basis of that paper. I mean, there are times, there are probably times that happens, but much more of the policy impact comes through ongoing conversations with people who understand, who know the research and are able to bring research to bear when very specific questions come up. And I'd say the project I'm doing now that I think has had the most impact is one in Mexico on labor courts with a collaborator, Joy Sadka, who is entirely engaged in making the policy on the labor courts. And the fact that she's able to bring the research that we're doing into the conversations has had enormous effects on policy, even with things that we've yet figured out how to get into a paper, that just haven't quite fit in the paper. And so I think this is something that we've tried to do with some success, but I think it's a challenge that we have to kind of keep working on.
And I have a related question for our editors. What have you seen in terms of the changes in submissions coming from LMICs? That's one. And then a second separate question. Oftentimes it's hard to be writing between fields for audiences in different referee pools. Do you have any advice for young researchers who are going to be submitting their papers in this intersection from your perspective?
Okay, let me see. So I think one of the things that I am a little worried about with the way that the submissions come in is that sometimes finance and development is a very specific thing. And I think we heard this sort of, Emanuele said this at the beginning, there's a little too much finance and development papers and a little too much development sometimes. And it's sort of hard to get the balance right. And I think that's sort of the problem. And so if you will send the paper to a finance referee and a development referee, you're very likely to get diametrically opposite reactions to that particular paper. Often, and then you have to adjudicate, which has always been fun as an editor. It's my favorite part of the job. So I sort of feel like the sweet spot is to, certainly from my perspective, is to sort of understand that if you were to take an evolutionary perspective and say, okay, maybe there's a journey that these markets are taking towards becoming something. What's the fastest way to get them there? What's going to happen once they get there? And this is sort of partly my focus on the middle class, sort of thinking about that group as being a very fast growing group. And maybe we should try and do as much as we can, sort of putting markets at the center of this conversation.
I think I was triggered when you said papers coming in. I still have happened a few years ago, so I don't want to think about the flow of papers. But I think it is at the intersection. I think if you look back to the financial crisis of 2007-8, that's what led the way, and Amir and I and many others got access to household data, and household finance became more mainstream in corporate side. It used to be something that asset pricers would have sort of worked on quite a bit because they were looking at life cycle models and so on, but not really in corporate finance, banking. So we did that, and it's in the intersection, and there was resistance. If you think about our NBAR groups, they're still called corporate finance and asset pricing. There is no banking, there is no household finance. So there is always resistance, but you got to do whatever you're passionate about. And there's lots and lots of exciting areas in this space. They are hard problems. I would just keep hitting, and hopefully editors will listen and say, yeah, you have to publish this. So that's what I would do.
Okay, so let's open it up. I think we should collect a few questions. Sufficient. Yeah.
Okay. No, first, this is a terrific conference. It's amazing to be in this room, and, been dreaming about this for long. So thanks, Emanuele, Emily, and Chris for making it happen. It's really terrific. And for young scholars, there is the webinar in finance and development. Let me make advertising. Emma, who is here, still at Chicago booth, benefited last week from 60 people giving her advice, and exactly on being at the intersection between econ and finance. She has a very nice paper that we will all be reading very soon. So okay. Now the question now is at the intersection between what Amit and Tarun were talking about. So Emily and Emanuele organized, and Chris organized this amazing opportunity in Kenya, where many of us were there talking to platform entrepreneurs, startups, and so on. Taking a step back, one thing I observed is the following. It aligns closely with this state capacity and tech relation Amit was talking about. Tech is flowing in Africa. The use of alternative data to create credit scores, to give credit to people who have never had it. And that's phenomenal. However, they learn really well the business model of tech companies in the Silicon Valley. And the feeling as an academic economist is they are learning how to build monopoly power, how extracting rents, how creating systems where you will be coerced inside with interest rates of 1-2% a day. Wow. And that benefiting the elite, right? Using technology basically to extend status quo. How do we think about consumer protection? In this case, it's going to be producer protection. In economies where the alternative doesn't exist, the outside option may be relational lending, which is expensive, difficult, and doesn't allow to scale up.
Is there a question?
Yes. How do we think about consumer protection and producer protection?
It's a great question. I mean, look, I think that's the thing. Like, if tech businesses are in the business of making profits, one of the things data allows them to do is to discriminate between borrowers in terms of profits. So there is a pooled set of borrowers, and now I can mine the data to figure out which one is safe and which one is not safe. I will cream skim. We know how economics works, right? I'm going to do cream skimming. Other folks are going to be left behind. And that's where the state thing comes in. So my encouragement to everyone is that we think about that broader context as well. it's great to do the first step or the second step, but there's a bigger ecosystem here that one needs to think about. And that's why it becomes important even in a context like US. So I'll stop there.
Yeah, I guess I heard a slightly different question, which is, do I worry that they extract the entire surplus? That is basically perfect monopolist. And I think my answer there is competition somehow. That making the data, making the data transportable, you can take to other people has to be part of. I mean, you've done some work on this, and there's work with the UPI in India, and I think that somehow has to be part of what we figure out.
It wouldn't be a panel without disagreement. So I think competition, I'll give you a counterpoint to that, which is, I sort of feel like one of the lessons from household finance is that people have learned how to compete on the wrong things. Okay, which is, if people are behavioral, then they have particular kinds of ways of looking at the world. Those ways of looking at the world are not the ways that rational financial economists would tell them that they should. Companies are very good at figuring this out. And then companies are very good at giving people what they want, which is not what they need. That's a source of market power. That's what behavioral industrial organization is about. And so I sort of feel like competition has not worked particularly well. I feel like nudges have had slightly, some effects. Maybe they're not as strong medicine as you think that they should be. They've pushed problems into other parts of the household balance sheet. So, I mean, one of the solutions that we advocate in our book, for example, is muscular government intervention in these kinds of situations. Okay, templating directly what kinds of plain vanilla financial products should be there. Providing a starter kit of products that should always be provided. Some of them should be mandatory to choose, some of them should be mandatory to offer. And that government should be comfortable about shutting down corners of the market when they are not particularly working well. Now, all of this relies a lot on state capacity. And so there's a big question mark there about how do you get that level of intervention. But that's one way of thinking about the problem.
I have a microphone from the next session. Go ahead, mate. Yes.
I guess I'm not an academic, so my perspective of the world is probably a little bit different from most of the folks that are here. And to me, it was interesting to hear Chris talking about give directly and actually lending, 70% of the capital came back and it can recycle. But that is theoretically interesting, but practically, if you want to scale, it's not interesting at all, because if you want to have a commercial business, your default rate has to be less than 95%. And so all the answer for that is for philanthropists and DFIs who are subsidizing. I think that maybe the academics should think about question that will scale and really is implementable rather than, theoretical. And in terms of the state versus finance discussion, in many of the countries in Africa that I care about, you can't change the state. And so, this idea that let's work to change the state, we can't even change our government, right? So maybe that's not so realistic in developing countries. And maybe the focus should be, how do we help the private sector to potentially leapfrog? And since I am from Silicon Valley, I want to say that tech is not always evil. But we can have that discussion sometime.
So let me just clarify the 70% number. So we in that paper, what we're doing is taking research papers. And as I said earlier in the comments, a lot of times researchers use things like subsidies to drive uptake so that they get enough statistical power to get results. So I think in that case, we want to back out the subsidies that are in those research papers to be able to do an apples to apples comparison between grants and credit. You're absolutely right that's not sustainable for a lender. And I don't think that's what we see with lenders. On the research side, we struggle more with sort of, I mean, again, this is now possible with administrative data and very large samples that you can get we can get closer to this. But so it's definitely right that's we shouldn't think that reflects what's going to happen in the markets. That's what's in research. We're trying to interpret what we've learned from that research, and it's that sense that we need to back that number out. But you're absolutely right. It has to be sustainable if it's going to actually be done, and therefore the repayment rates have to be a lot higher than they are in the research papers.
Again?